Hello, welcome back to Mali Investment Talks, a series of talks during which I try and I hope I empower you to be able to make independent, intelligent, and competent financial investment decisions by yourself so that you are able to achieve your financial goals or goals such as financial independence, goals such as having income, investment income, being able to grow your investments or grow your wealth basically, goals such as having sufficient liquidity in your assets. So I hope that I am empowering you and you feel empowered after you listen to or talk or watch me to be able to make those decisions or ask the right questions if you have to consult someone else. In the last episode, we were talking about the do's and don'ts of bonds. Today, we are going to continue the same discussion, do's and don'ts of bonds, but with a slight difference in that whereas in the last episode we talked more about treasury bonds, today we're talking about corporate bonds. If you like, you can call them company bonds. Bonds issued by corporations or by companies. You see, it is not only governments which issue bonds, even corporations or companies can issue bonds as long as, of course, they are licensed by the appropriate authority. Okay, so once again, we're talking broadly about bonds, but specifically about corporate bonds. And if you remember, on the positive side, bonds will give you generally good yields. Bonds are generally liquid. Even corporate bonds in our region, it's mostly in Kenya where you would find a lot of corporate bonds being issued. The bond market tends to be liquid and they generally give you good income. However, for corporate bonds in particular, I need you to be aware that the risk level is going to be much higher. Okay? The risk of loss, what we call credit risk, the risk that the issuer of the bond goes down or is unable to basically pay you. That risk is much higher when you're dealing with corporate bonds as compared to treasury bonds. Companies do go down. In Kenya, I know that not too long ago, that risk, the risk of companies being unable to basically pay their bondholders came alive. It was real in so many respects. So you need to be aware that when you're buying a corporate bond, you are exposing yourself to a slightly higher level of risk, which can be managed, but you just need to be aware. That risk will be usually a function or will depend usually on the management of the company. If the management is not doing something untoward, then that can result into that kind of risk becoming reality. It could depend on developments in that economic sector in which the company is operating. Generally, it could depend on the company fortunes. So you need to be aware of that. So it is very important, therefore, before or as you buy or prepare to buy a corporate bond, to understand the company's fundamentals. What does that mean? How has the company been performing? in terms of profitability, return on how has it been managing its capital, managing its assets, return on equity, and all those basic fundamentals of the company. How well has it been managed? How stable, for example, is or has the management been over time, or have they been changing management every couple of years or so? That, of course, could be something to worry about. In brief, do take time to read the prospectus. That's a document that the company by law is required to issue to guide investors about the prospects of that company before they can buy a security issued by that company. So read the prospectus. If you are unable for any reason to understand or read the prospectus, please talk to someone who has read it, your lawyer, your financial advisor. Make sure that someone either has read the prospectus and can help you understand it, or understands the company well and again can help you to understand it. That is, if you don't understand it yourself, or you don't have the time or the skills to enable you to understand the fundamentals. The last thing, the final thing I would say about corporate bonds, but the advice I would give is, as much as possible, try to access corporate bonds indirectly. I would prefer to access them indirectly, say through a fund, as opposed to directly by me going to buy the bond myself. And there's nothing wrong with that, you can do it, but your risk will be better diversified if you accessed this bond through, say, a fund manager who will at the same time invest in several other bonds, several other products such as we've discussed. So that if something went wrong with this particular company who has issued the bond, it will not be the end of the world. Okay? Some of your money has been invested in other products, and therefore, from a portfolio perspective, from a portfolio level, you will basically still be okay. But if you went directly and you put a lot of your money into a particular bond, and God forbid something happens to the company, like I said, happened in several instances or in companies in Kenya a few years ago, then that could, the financial implications could be disastrous for you, as that could then go down with all your money that you would have put in there. Okay, thank you again, as always, for listening carefully and for watching me. And I hope that once again, each time I give you these tips, I help to empower you in making crucial financial and investment decisions to ensure that you have financial independence going forward. I look forward to talking to you again in subsequent episodes, and don't forget to take note of my contacts. Reach out to me if you need further details, and subscribe to this channel so that you keep getting updates going forward. Thank you.